Hey everyone, welcome back to Corporate Decoder. Today we are diving into a company that's received a bit of a financial wake-up call. Think of it like getting a letter saying your account is running low. We're going to decode exactly what happened, what it means for the company, and whether it's time to worry. We are looking at a report filed by Alaunos Therapeutics in April of 2025. Basically, this report tells investors about some important events that have happened recently. The first big piece of news is that Nasdaq, the stock exchange, sent Alaunos a notice. This notice said that Alaunos doesn't meet the minimum requirements to stay listed on the Nasdaq capital market. One of those requirements is having a certain amount of stockholders' equity. Specifically, Nasdaq requires at least $2.5 million in stockholders' equity. Alaunos reported just over $2 million in its yearly report. Stockholders' equity, you can think of it as the value of the company. If you sold all its assets and paid off all its debts, it's like the company's net worth. Now, this doesn't mean Alaunos is immediately kicked off the Nasdaq. They have some time to fix this. They have 45 days to submit a plan to Nasdaq showing how they will get back into compliance. Think of it like a student failing a test, but getting a chance to do extra credit to raise their grade. If Nasdaq accepts their plan, Alaunos could get up to 180 days to prove they can meet the requirements again. That gives them about 6 months to turn things around. There's also some other news in this report. Alaunos got another notice from Nasdaq. This one says they are no longer under a panel monitor. This means that the company was under special watch for a year, starting in February of 2024, but that period is now over. It's like finishing a probation period. Now let's step back and look at what this all means. Alaunos is a company that's developing cancer therapies, so any financial uncertainty could impact their research and development efforts. The fact that they don't meet Nasdaq's minimum equity requirements is a red flag. It suggests they may be struggling financially, maybe they are spending more money than they are bringing in. They need to come up with a solid plan to convince Nasdaq that they can improve their financial situation. This could involve raising more money, cutting costs, or finding a way to increase their assets. For now, investors will be watching closely to see what steps Alaunos takes to address this issue. The clock is ticking and they have around 6 months to show that they can get back on track. Or they might be delisted from Nasdaq Market if they get delisted. It would make it more difficult for them to raise money and could hurt their reputation. In my opinion, Alaunos is facing a challenging situation. Their failure to meet Nasdaq's minimum equity requirements raises concerns about their financial stability. While the end of the panel monitor period is a positive sign, it doesn't outweigh the bigger issue of their low equity. The company's future depends on their ability to execute a credible plan to regain compliance with Nasdaq's listing rules. This could involve strategic partnerships, cost-cutting measures, or successful clinical trial outcomes that boost investor confidence. However, there is a real risk that they may struggle to raise enough capital or generate enough revenue to turn things around. As it stands, Alaunos is a high-risk investment. Investors should carefully consider the potential downsides before investing in this company. They need to do their own research and watch the steps the company takes and assess if they are enough to pull themselves out. Thanks for watching Corporate Decoder. If you found this breakdown helpful, please like, comment and subscribe for more insights into the world of corporate filings.